if you are presently financing cars the traditional way, you may end up spending more money financing cars than you would ever save for retirement. If you can finance cars a different way or a better way, as you keep building your wealth for retirement, you are going to be in a much better financial position. If you are financing things outside becoming your own banker, you do not control those financing terms. Someone else is controlling it for you. You cannot take a vacation from that payment. Whereas in this scenario, you have total and absolute control. You can take a vacation if you want from a payment. Nobody's going to come after you for the loan repayment. I am going to be diving into our first case study. It is focused on financing cars. And the reason why we are using a case study on financing cars, is because car is the most common commodity that we all need and we can relate with it. But the process of becoming a banker is not just for financing cars, it's for anything that you have the need for use of money for. Now let's look at different ways of financing cars. So let's look at the traditional or so-called conventional ways of how people go about financing things in life. So the first option is the lease option. We all aware of leasing. The second option is bank financing, where we qualify for the loan and then we make consistent loan repayments back to the bank based on the loan amortization. And the third way is paying cash. So whether we borrow money from someone else or someone else's bank and we pay back principal and interest, which becomes a financing decision, because whenever interest is involved, it's financing. So the first two methods are considered the conventional financing. Now, the third method, cash, is also financing, because when you pay cash for goods and services, your money is gone and you're not going to earn any interest on that money ever again. So the financing decision of using cash is the decision of never to earn any interest again. So all three methods are a financing way of acquiring things today. So some of the personal things that people finance: cars, appliances, furniture, home renovations, etc. And if you are a business owner, you may be financing buildings, office furniture, computers, photocopiers, human resources, cars, equipment, operations. So any decision that you make with the use of money, whether it's a personal use of money or whether you're using corporate dollars, you are making a financing decision for every transaction presently. I'm going to show you a better way of financing things going forward. And that better way, which you are aware of, is called the process of becoming your own banker. Now, this family that I want to share this case study of, they actually were introduced to this concept back in October of early 2017 is when they discovered the process of becoming your own banker. So they came through the education process, just like how you folks are educating yourselves on the process. They've read Nelson's book, and then they got connected with me. They were age 40, so husband and wife. They're both age 40 years young at that time. And then when they met with us, they had some questions, and certainly they wanted to see how this process can be applied in their lives personally, how to achieve the things that they want to buy going forward, to achieve their financial goals. So the main goal that they have after understanding this process was to take over the banking function over the car financing, because they understand that they need cars till the end of time, and every 7 years they buy a new car. And they knew that there's a problem because they had already purchased cars up until that point, up until age 40. And reading Nelson's book, educating themselves through this process, they realized that they did accomplish the objective of buying those cars, but all the money was gone and they wanted to change that. Here's another fact about financing cars the traditional way. If you are presently financing cars the traditional way, you may end up spending more money financing cars than you would ever save for retirement. If you can finance cars a different way or a better way, as you keep building your wealth for retirement, you are going to be in a much better financial position. And this is what we're going to show you via the process of becoming your own banker. Their next car purchase was coming up in 2019. So they met with me in 2017. So they're looking 2 years ahead, because planning is important, right? What's the saying? If you fail to plan, you're planning to fail. So they're looking ahead. They're like, we want to be prepared. In 2019, we're going to buy a car. And the next car that we're going to buy is through the process of becoming a banker, because we want to build wealth while buying that car. And we want to recapture those stream of payments so that we are in a much better financial position when we retire in future. And in addition to that, they also wanted to protect their family from life insurance standpoint because they had no life insurance at that point. Now, some facts. So in my discovery with them, so that's the first thing that we do is, well, we connect, we see if there's a basis for us to work together. And if we confirm that from both parties, you need to be comfortable working with us, and we need to be comfortable working with our prospect or former or new clients. We do a discovery. In that discovery, we capture income, assets, liabilities, and goals. So I'm just highlighting some of the things that I discovered in that meeting. So family income at that time, $180,000 between husband and wife. Husband was earning a little bit more than the wife. And then they are savers. They set aside $25,000 per year, but no different than anybody else. They had been setting that money aside in the books of someone else's bank. They had no life insurance. Now, they did purchase 3 cars so far, as I mentioned, until age 40. Between the two of them, they had bought 3 cars. The average cost of car was $25,000, and they had used cash purchased, and they had also used bank financing up until that point. So if you do some math, $25,000 for 3 cars, that's $75,000. And that money was gone from their family forever. And that money created a negative net worth for them as a family because someone else got their money. That money could have been with them forever, but just because they didn't know any different, they had transferred that money away. And we're going to solve that problem. We did solve that problem for them by implementing the process of becoming your own banker. So here's what this family did. They started a policy immediately because they didn't want to penalize themselves any further. They've been penalizing themselves for many, many years. They want to take action. They started a policy in 2017. The premiums that they decided to use for this policy because they wanted to capitalize. They believed in the process because they educated themselves. They've got all their questions answered. And once you know what this is all about, you know exactly what to do. So Nelson's first golden rule, don't be afraid to capitalize. They are capitalizing their banking system with $20,000 per year in premium. They were already setting that money aside in a commercial bank, $25,000 per year. Remember, they were saving that money. They're just changing where the money is going to be saved. They're not changing their cash flow. They're not working any harder. They're just changing where the money is going to be saved. The starting death benefit, so the participating whole life policy was on the husband. The starting death benefit was $680,000. God forbid, he puts 20K into policy, he dies, his wife and family gets $680,000. Before this, he was keeping money in a commercial bank, $25,000, and he died. The family only gets the equivalent to the bank account. There's no death benefit there. So by changing the address of the money, we created an estate value for the family. Here's another fact to consider. Years from today, whether it's 1, 2, 3, 4, 10, 20 years from today, there's 2 possibilities. Either you're going to be alive or you're going to be gone. Why we are the implementation of this process, you're going to be just fine because all the access to cash and the growth, and God forbid, you're no longer with us, your family is going to be taken care of because of the tax-free death benefit. So we solved the problem on husband, the permanent insurance by getting him going on a participating whole life policy. And for the wife, for the interim, we had just started a term life insurance just because we wanted to insure her life. And that term life insurance will be converted into a future participating whole life policy for the family when they're ready to expand their family banking system. When banks become profitable, they open more branches. When we become profitable, we open more policies. So let's fast forward. Let's fast forward to 2019, October 2019, when they're ready to buy their car. So this is the car that they purchased, that very exact car. The price tag on the car was $35,000, October 2019. Now the options available, as you are already aware of the traditional options, cash, finance, or lease, they didn't opt for any of those options anymore. They went with the process of becoming your banker route. So 2019 car financing using this process, the cash values at that time in 2019 were over $35,000. So remember, they started the policy in 2017. They want to be prepared in 2019 when the next car was coming up, when the family wanted the next car. So in 2019, they had way over $35,000 in cash values, which is more than enough money to finance their car from their own family banking system. Now, the daily cash value growth. So as Vern he did such a fantastic job taking the time to educate on the daily growth aspect in the policy. So the cash values in this policy grow every day. Back in 2019 for this policy, the daily growth was $20 per day. Now, how do I know what the daily growth is? Because I am the advisor for the client. I can look at the values today. I can look at the values the next day. The difference is the daily growth. So in 2019, the daily growth was $20. As of today is 2022. That daily growth of cash value is much more. It's not $20 anymore. It's much more. Back in 2019, it was $20 a day. The capital required to purchase the car was $35,000. Now, what we can borrow as a loan from the insurance company against our cash value is 90% loan to value. So we can borrow 90% of our cash values as loan. So like I mentioned, they had way over $35,000 in cash value, and the loan amount was $35,000. They could easily take a loan of $35,000 to go buy the car. The death benefit in 2019 had increased to $750,000. It started at $680,000 in 2017, and now in 2019, it is $750,000. As Vern mentioned, the way we design policies is the death benefit increases every year, which accelerates daily cash growth in the policy at the same time. So car purchase. So here's how they went about buying the car. They took a policy loan, and here's what the process looks like. A policy loan is a single-page document. The input required on a policy loan document is you put in your name. So policy owner's name is required. You put your policy number in there. You put how much amount you need as a loan. What you can borrow is equivalent to 90% of your cash value. And all you have to do is let the insurance company know whether you want to receive that money as a loan electronically deposited into your bank account, or you want to receive that money via check. Both options are available. If you ask them electronic deposit, the money is deposited in 7 to 10 business days. If you request a check, well, then it depends upon how long Canada Post takes to deliver the check at your address. And then after that, all you do is sign and date. This is how we request a loan from the insurance company. This is how they're loaning their car. This is how they're financing their car. Now, if you financed car the traditional way, and you know the whole qualification process that goes into financing the car traditional way, compare that process with this new process. See, everything in life is comparable. Traditional financing qualification versus a loan from the insurance company. It's obvious the loan from insurance company is an easy way to access the loan versus the traditional way of qualifying from the bank to buy the car. So there's no qualification for the loan, and there's no consent to repayment terms, because when you request a policy loan, insurance company will use your cash as collateral for the loan, and they'll put a lien on your death benefit for the loan. In case death occurs and the loan is outstanding, they'll deduct it from your death benefit. The key word that I just mentioned is that lien is on the death benefit. When you are financing things from the traditional bank, and going back to the same example, let's just say you're buying a car and you're going through traditional financing, your car is collateral, the lien is your income. Because if you don't repay the loan, they'll garnish your wages. In this case, the lien is your future dead self. So when you're accessing loan from the insurance company to buy the car, the lien is your death benefit, not what you're going to use the money to buy. So technically, this family owns the car free and clear because the lien for the loan is death benefit. There's some important facts in policy loan. Outstanding policy loans, they do not impact your daily cash value growth. Your cash value, your capital, your wealth continues to grow every single day. In 2019, I'm going to repeat myself, the daily growth was $20 per day. The loan did not interrupt that daily growth. The outstanding policy loan doesn't reduce your death benefit while you're alive. Your death benefit continues to grow every year. Your outstanding policy loan doesn't negatively impact any future dividends. Your dividends, your share of profit is not negatively impacted by an outstanding policy loan. Outstanding policy loan doesn't show up on credit report. As I mentioned, the loan is private between you and the insurance company because the lien is death benefit. Keeping things private today is in your own best interest, the way things are. As said, any outstanding policy loans will get deducted from the death benefit and the family gets the remaining money. So let's fast forward 2019. The daily growth after accessing a policy loan was $20 a day because the loan did not interrupt the daily growth. Now, policy loan initiated $35,000. Family received the money in 7 days. The objective of buying the car was accomplished by using insurance companies' money while their money continued to grow and compound in the policy uninterrupted. Now, when you access someone else's money, in this particular case, it was insurance company, there is interest associated with that loan. Now, this particular company back in 2019, the simple interest charged on that loan was 7%. That interest has gone down since 2019, but in 2019, it was 7%. So what they borrowed was 35,000. So 35,000 multiplied by 7% divided by 365 because simple interest is charged on daily basis. This is the daily interest on that loan, but the loan does not interrupt the daily growth in your policy. Take a minute just to see and understand what just happened. Are you okay growing $20 per day of your own family wealth at a cost of $6.71 in interest on a daily basis? If I say to you today, give me $6.71, for every $6.71 you give me today, I will write you a check for $20. How many times would you give me the $6.71? The family decided to pay back policy loans to the insurance company, and the loan repayment that they set for themselves was $500 a month. So they decided as a family from their cash flow, how much are they comfortable setting aside every month without bending and breaking the family lifestyle to replenish what they have taken out because they are practicing banking. They're not going to steal the peas. So family decided $500. So if you borrow $35,000 and you're paying back at 7% at $500 per month, it'll take you 84 months to pay off the loan. That's their amortization. Now, going forward, they can increase the loan repayment or they can reduce the loan repayment. It's completely up to them. They are in total and absolute control over the financing terms, and they have a car that is owned free and clear. If you are financing things outside becoming your own banker, you do not control those financing terms. Someone else is controlling it for you. You cannot take a vacation from that payment. Whereas in this scenario, you have total and absolute control. You can take a vacation if you want from your payment. Nobody's going to come after you for the loan repayment. All right, let's do some basic grade 3 math. So monthly cash value growth is $600. So if you take $20 per day, multiply by 30, 20 times 30 is $600. Now, monthly loan repayment back into the system is $500 a month. Now, the monthly interest is $201. So if you take $6.71, multiply by 30, that's $201 in interest. Now, let's look at what happened in that transaction for the very first month. Family's net worth over this transaction. So the growth in cash value, which is their wealth, so 600, plus what they're repaying, $500, minus what's going to go to the insurance company, which is 201. So that equates to $899. So just take a moment to see what just happened. They're making a loan repayment back of $500 a month, and they can access $899 just in the first month again. So where else can they pay back $500 and have access to $899? Where else can you pay back $500? If you were in this situation, where else can you pay back $500 as a loan and create access to $899? Car is a depreciating asset. Just by changing how they're going to finance things, which in this case is the car, they just converted that depreciating asset into an appreciating asset because the real asset was never the car. The real asset is the stream of payment. If you are the one controlling the financing function by becoming your own banker, this is what you create for your family, positive family net worth by financing things differently. You are going to finance things. Financing is not going to end for you. But what you can certainly change going forward is, how are you going to finance things? Do you want to make progress? Then this is the way. If you're okay with what you're doing, then that's the way. And by the way, I haven't even factored in the dividend at all. All the questions that came into the Q&A, hey, what's the dividend as compared to my interest? I haven't even factored in the dividend in. Dividend is an icing on the cake. If it's there, great. If it's not there, it doesn't interrupt my process of becoming your banker. This will happen regardless. Interest rates go up, interest rates go down. One thing doesn't change going forward. That is called the function of banking. Someone must control that for you, and that someone should be you. And if you do so, this is the exact outcome you will create for your family. So for this family, they're building wealth while paying off debt, which is the policy loan. They're continuously compounding family wealth and building for retirement because policy loan never interrupted any of that. And by their behavior of paying back policy loan, they're creating access to more capital in future. They're recapturing money. They're recapturing the loss of money. They're practicing the process. They're not stealing the peas. They have total and absolute control over the loan repayments. They are their own bankers. Policy loan is private between them and the insurance company. The car is owned free and clear. If a car is owned free and clear, they must have gotten a discount on the insurance. And that extra discount on insurance can also be used as saving to pay back policy loans or maybe do more policies. God forbid if the husband dies, he doesn't leave any indebtedness behind to the family member. There's enough death benefit there to eliminate any outstanding policy loan balance, and the family still gets a ton of tax-free dollars. The interest payment on policy loans adds more profit to the business that the family owns. Interest is profit for the business called the insurance company, and that profit is shared with all existing owners, people who have participating whole life policy as profit. We're in this together. They pay back $500, including interest. They're able to access $899. So they're able to access more than what they repaid. And plus, they're also going to benefit from the interest payment. It's a win-win. Creating more access to capital for more future opportunities. So by practicing the process, they're replenishing the money, they're creating access to more opportunities. And what can those opportunities be? Can that opportunity be another car for the family? Can that opportunity be an investment property? Can that opportunity be private loan? Can that opportunity be to educate themselves, maybe go through school, college again? The process of becoming a banker is also called the infinite banking concept. And Nelson used the word infinite because you cannot put boundaries on infinite. It's limited to your imagination. Have you purchased your last car? Maybe the answer is yes, but most likely it's going to be no. Think about the cars that you will still need to buy. Knowing what you know now, how much more of your hard-earned money are you willing to say goodbye to? How much of your more net worth are you willing to reduce just by financing things out of your family banking system? If your answer is zero, then we can absolutely help you achieve that because we practice what we teach. We have helped thousands and thousands of Canadians, individuals, business owners, implement this process in their life successfully, and they'll never have a bad financial year because we are going to be working with them, coaching them going forward on it. You're not going to be doing this alone. We are going to be with you every step of the way.